presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello everyone and welcome to the Compact Market Wrap Update for August 3rd, 2026. I'm Moe Ansari, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President, right here at Compact Asset Management. Thank you for joining us today. Quick housekeeping note, click on the subscribe button so whenever we post an update, you'll be notified and you can watch it at your convenience. Also, if you want all the episodes, just go to compact.com, click on Insights. All the different episodes are there. All the YouTube updates are there. So when we talk about the charts, you can exactly see them. If you need help with your portfolio, send us an email at invest@compact.com or just give us a call at 800-388-9700. Javaid, let's start with the numbers last week. A good week, okay week. What do you say?
It was down beginning of the week as kind of things, market was a little choppy, still trying to figure out the situation with Iran. But then earnings came to the rescue. Amazon had really blowout earnings, huge increases in their cloud revenue, a lot of that related to AI. And so they were up almost 15-16%. So we saw a nice kind of, I think, rebound in the Magnificent Seven. We haven't seen that. I don't know if I love it. I mean, I love it when things are broadening out. If things kind of go back to that narrow type of leadership, something to kind of watch. But hey, in the end, you got to take a big perspective here. Market is, I think we're at all-time highs today. Nicked it today, and so we've been rallying through the end of last week. But S&P up 1%, Dow up 1%. Russell took a little bit of breather, flat for the week. EFA up 2%, emerging markets up 2.37, and the Nasdaq up 1.6. You look at year to date, S&P's up 10%. Yeah, so anytime you get double-digit returns, once again, on the back of double-digit returns, it's just a pretty good place to be. So I think we've seen interest rates go a little bit higher with oil prices, but the market, as long as earnings continue to come through, these tech companies are continuing to spend all of this cash flow that they've accumulated over the last 6, 7, 8 years. They're reinvesting into the economy. That's still promoting, overall GDP growth is in the right direction, even though people can kind of nitpick, exactly.
It was down, to 1.5% GDP. But when you look inside those numbers, a lot of it was inventory drawdown.
Yeah.
So that has to be rebuilt sooner or later,
Correct.
And that'll give a boost on the other side. So I'm not as concerned about the GDP number. One thing that was sort of concerning is the Fed. They did not raise interest rates. And Warsh came out and said he was pretty wishy-washy.
Wishy-Washy Warsh?
It was a wishy-washy Warsh. That's what it came out to be, because he said, well, we let the market decide. And the market really did take a huge jump in interest rates right as he was talking. And that said, the market gave its opinion that probably we need an interest rate increase if inflation continues. He kept on talking, I'm going to bring inflation down to 2%, and that's our number, and so on. But the market said, okay, how are you going to do it? Show us, don't tell us. That's basically what it's come down to. So the probability of an interest rate increase at the Fed meeting increased and interest rates went up. But the market sort of shrugged it off because a quarter-point interest rate increase doesn't really change anything as far as the market is concerned.
And I still do feel like there is some, now we're seeing a little bit more inflationary pressure, clearly with oil prices resuming back to the upside over the last month or so. But yeah, there's still a lot of disinflationary pressure as well. So it's really hard. Economy is still growing. So I think the Fed's they're right where they need to be. Whether it's another 0.25% higher, even 50 basis points higher or lower, I don't think that's going to be the straw that breaks the market's back. Right.
It's
ultimately,
earnings.
It's all earnings.
It's all earnings. I've said for 30 years. That's what drives the market. The more money a company makes, the more valuable the stock is. The question is the ROI on all of these hundreds and hundreds and hundreds of billions of dollars that is being put into AI. And getting the return, especially with China, is giving it away for free.
Well, yeah, they just mentioned, I think DeepSeek is 99% cheaper. I don't know how you can be, why don't you just round it to 100? But it's 99% cheaper than the frontier AI models. And I think that's why you're starting to see, we had all of this enthusiasm around SpaceX.
Right.
Well, that's kind of, that rocket's not leaving the land.
That fizzled out. That rocket didn't go anywhere.
It didn't leave the launch pad. And so now you're looking at Anthropic and OpenAI. They were getting, we got a window here. We got an IPO. We got to get it going. But now that their business models, that once we talked about it on Market Wrap about a month ago, where now this would be the pure play on AI. Is that if Anthropic and OpenAI go IPO, then now you have a way to kind of say, okay, this is the value of AI. And not the infrastructure build out, not the advertising, not the phones, Apple, Amazon, all these other things. They have core businesses, and AI is just a component of that. Anthropic and OpenAI, this is their business. And so what is that business worth? That's still kind of the question mark. I think the Magnificent Seven are still going to use AI to their advantage.
Yeah, they are. They are going to do it.
And the S&P 500. Other companies are going to use the AI to their advantage.
But what will it cost them? Will the AI companies make enough money from everybody using their AI? Or will they just say, hey, we've got one that's 99% off?
Yeah.
Would you buy something that's 99% off? Or would you buy something that you got to pay 100% for? That's the question, and that's what people are starting to ask. Are they going to really monetize AI where people using it will pay for it? And how much are they going to pay for it? How much are they going to make on this? That's going to be directly those companies, AI companies that you mentioned, OpenAI and Anthropic, how much profit are they going to make? Mm-hmm. That's when they go IPO, they've got to publish their results, and then we'll have to wait and see. So that's why the market is a little wishy-washy on AI right now. But I think the other 500 are really going to benefit from AI.
Yeah.
They are really going to, productivity is going to go up. They're going to make a lot more money. So that's why people are shifting, and we're seeing a broadening in the market. Mm-hmm. That's the way I'm looking at it right now. Consumer discretionary had a great week last week. Utilities not as good. Consumer services was up. Technology was sort of flat.
Yeah, I think technology hasn't really done much. I mean, you look at it this year; it's up 15.7% this year. But you look under there. There's some, potentially the Mag 7 hasn't really been driving it, as much. I think there's maybe some opportunities there. I was looking at Nvidia. Nvidia hasn't gone anywhere since October of 2025. It's basically flat for the year. Google bounced back nicely. I like Google long term. Clearly, Amazon with their web services, I think they're going to really benefit from AI dramatically because Google knows what you search. That's great, but Amazon knows what you buy. And so then applying AI to those analytics, to that data set, I think is going to be incredibly powerful, where the AI is just going to basically automate what you buy. So you don't even have to think about it anymore. It's just you show up, and as you expect those packages right on the front door, you didn't even click the button. You just it's like Christmas every day. AI is bringing it to you. So I think all of that's on the horizon. Then of course you still have to deal with the rogue AI and all of these other regulatory things around AI. So it's very much the Wild West, but in the end, the earnings are still coming through. The guidance is still there. As we talked about, I think in Market Wrap last week, the 3-month, forward guidance on revenues, those all are looking at 90% of companies are raising their revenues forward in guidance. So that doesn't turn around overnight. And so, that's why the market's still at all-time highs, even though interest rates have gone up. There's a conflict in Iran.
If we can get this conflict settled somehow in Iran, I don't know how it's going to be done because it keeps on broadening out. Right now, I mean, the Yemenis are firing missiles and
I think MBS, Mohammed bin Salman, who's the crown prince of Saudi Arabia, I think he had a conversation with President Trump last week and said, hey, I get it. We want to kind of talk a tough line with Iran, but if they start bombing, our infrastructure, our oil infrastructure in Saudi Arabia, we're not talking about just oil not going through the Strait of Hormuz. We're just saying there's no oil. And so if there's no oil, and they really knock off some of those, supply lines and refineries, those aren't getting repaired for years, oil prices go to the moon. And so, clearly, as we talked about, ultimately has to filter through into gasoline prices. Gasoline prices are still, I'd say, very kind of moderate. And I'm also, maybe we'll transition right now. Now it's August 3rd. we're about 3 months away from the election.
Right?
So,
yeah.
and I'm starting to feel that maybe, it wasn't looking good for the Republicans, but with the economy still doing very well, we're going to get jobs numbers later this week. I think those are going to be pretty good. Not great, but good enough. Inflation is still, everyone doesn't love it, but I just don't know if the Democrats are going to do quite as well as they anticipated, because everyone's kind of weathered this, at least the market is saying, we've kind of weathering all of these kind of events pretty well so far. I don't know, what is your opinion?
I think the Democrats, everybody was saying it's a slam dunk, they're going to win. But now they're fighting amongst themselves. The left wing has come out and said we want democratic socialism or whatever they call it, and they want to tax everybody and let's take money from everybody and all of this stuff. And when you talk to the middle America, where America's at, I've always said the fringes are always going to be there, the left and the right. It's the middle of America that drives the country. And those middle people are, they're saying, yeah, inflation is bad, but it's not really that bad. Economy is doing great. And at the end of the day, it's the bread and butter issues that make the election or break the election. You can talk about global warfare and all of this global politics. People don't care. People care about their their kitchen table. They talk about their jobs. They talk about how much they're paying. And that's going to decide it. How bad is inflation? Is it going to make everybody run to one side or the other? I don't know yet, because when you look at the middle class, yeah, they're not doing as great, but they're not hurting. Jobs are plentiful. And that's why I think it's going to be a much closer election now than it was a month and a half or 2 months ago.
Yeah, I think it's going to be really interesting, because if you look at, as you always say, it's the economy, stupid, right? It's the jobs. It's how's your job doing? Inflation is kind of how's your wage doing? Is your wages keeping up with the expenses? So on one sense, everyone's fully employed. They're feeling fine about their jobs. But in the other sense, they're feeling like their wages aren't keeping up with inflation. If they're lucky enough to have stock market investments, those are at all-time highs. So they're feeling the wealth effect. Their house, if they're fortunate enough to have a house, that is the wealth effect has never been higher. Yet you look at consumer confidence, it's never been lower. So it's kind of, you have just so many of these cross currents, and I think that's being reflected in the market.
Right.
Where we're just kind of going back and forth, haven't really done anything. You have a lot of positive things, you have a lot of negative things. It's really interesting to see how it's all going to come out in the end. Fortunately, I think everything's somewhat in equilibrium.
Right
and
now,
so, we can just
But it can
continue.
tip either way. That's the thing. If the war goes away, energy prices come down to $70, $65 a barrel, the whole equation changes.
Yeah.
I think. If the war broadens out, oil goes to $120 a barrel, everything changes.
Correct.
So, and nobody knows, because it could go either way, and that's why the market doesn't know, and the market is just chopping around. One day we get, okay, we're going to bomb the heck out of Iran. Next day we say, no, we're negotiating. Iran goes, say, no, we're not negotiating. Who knows what's going on? And that's why the market is so choppy right now. That's the way I'm looking at it. Oil still at 80 some dollars a barrel. It's down today. It was down more, but now it's come back up a little bit.
And gasoline's slowly creeping up, but it's still only at $4.10.
Yeah, above 450 is where it really starts
kind of gets into that
yeah.
yellow zone.
Yeah, it's still right around 4. Interest rates jumped up to 4.75, and that's something to watch, because Warsh said, I'll let the market make the decision.
Well,
And the market came 5 minutes later, made a decision.
Yeah.
As soon as he said that, the market said rates have got to be higher.
And rates came down today. We're down below 4.7 today. One of the things I'm looking at, though, in high yield in AGG. So we'll look at the chart. And I know we're making all-time highs. We closed a lot of the gaps on the charts that we had back from July. So we've kind of cleared away all the upside. Now, can we go higher from here? Potentially. But one of the things I'm watching is, AGG was down last week, 0.12. High yield was up 0.18. I would love to see that. But looking at it today, HYG was down 0.22 and AGG was down 0.13. So HYG was down more than the overall bond market. So
You
I
don't
think
like that.
though that's kind of an early sign where we start to see, if we start to get concerned about what's happening with the economy, if we start to see interest rates come down and basically the HYG also starts coming down from these levels, that's going to be something that I think is incredibly concerning for us going forward. And it's something we're going to have to watch here, I think, over the next couple of weeks.
Yeah, FOMC kept rates unchanged, which was a little bit of a side. Consumer confidence is down, as you mentioned.
Yeah.
It's down again to 90.5 and 0.8 in July. And that, I think, is something to watch, is consumer confidence, and see what happens. A lot of data coming out this week. We've got the ISM coming out. We've got unemployment coming out. We've got factory orders coming out. So a lot of data will give us some idea of how well the economy is doing.
Yeah, I think with ISM still looking very positive. Manufacturing, I think, is at record highs at 53. We'll get the job data, I think, here on Friday. We're only expecting maybe 80,000 in jobs. So everything seems to be, it's not rip-roaring, but it's not negative. Everything just kind of seems to be in kind of second gear.
Yeah,
it's still moving
cruising
forward.
along.
But we're not ripping forward, and that's to be expected. We've been in fifth gear, I think, for the last 2 or 3 years. We put up a chart a couple of weeks ago showing that this has been one of the best 4-year rallies that we've had since 2022. So it just makes sense. If we just need to kind of pull it back, put it on cruise control for a little bit, but still headed forward, that's all we can ask for.
Looking at the charts, market is pushing the new all-time high right here.
It was 76.08, I think, was the all-time high. I think we nicked it today, closed that gap today. We hit, 76.10. So
all-time high, intraday
high.
So the projection for the Fibonacci from here to here, this line is the projection, which is 7,700. That's only 190 points from
about
where
another
we are.
percent.
Yeah,
percent
another
and a half.
percent. Yeah, that's all we are looking at right now. But new all-time high. One thing we do want to know, and we'll put this out next week, remind me to put it out on the chart, is divergences.
Yes.
Well, that means, what do I mean by divergence? That's when the market goes to new all-time high, but the technical indicators don't go to new all-time highs. Like the RSI, the MACD, and I'll put out the RSI. If it does not make a new all-time high, that is called a divergence, where the price goes to new high, but the technical indicators do not confirm it. And if we get a fifth wave top around here, wave 5, with divergences.
Well, especially if you look at the weeklies. So if you fast forward to the weeklies,
they already show it.
We're already there.
Yeah, that's the thing. This 5 might
move over.
Just move over to here, but just a slightly higher high. So we'll see. I just think the market is, look at this rally that we've seen since October 23.
And let's, calling tops and bottoms, as you always say, is dangerous for your wealth. And so we're not saying there's a top, but there's a lot of ingredients there. And you can have these extended fifths. It can continue for some time. Typically, tops also take time. You don't get the V unless you could just have an exponential move higher, which is really tough for the S&P 500.
Like this V bottom that we saw in April of...
V bottoms, you can get some pretty quick bottoms, but I'm saying tops, take some time. They tend to roll over.
They roll over, take some time, and they just go back and forth. They're rounding tops usually. They're not Vs like these.
Yeah,
That's what we see on this. And NASDAQ daily, it came back up today, the 50-day moving average.
Yeah, with the Mag 7 rallying last week.
Today. It's right at the 50-day today. New all-time highs, we could get them, but we'll have to wait and see. But if you look at the weekly chart, you've got a fifth wave top already.
Yeah.
So, that's what we're showing on the S&P. That's what it looks like on the NASDAQ. So we could bounce around here for weeks and weeks and weeks. On the weeklies, but it's showing that it might roll over a little bit, make a new high, but just a marginal high is what I'm looking for if that happens.
And then you're also talking about your dot plot.
It's getting closer and closer, all these dots to the market.
Which is great. When I look at, when we look at technical analysis, a lot of it is trend following, right? We're trying to really kind of understand where's the trend. And the key thing is is the trend is your friend. So as long as the trend's moving in the right direction, don't question it. Don't say, oh, I need to get out just because the market's high. And if you would have been doing that, you would have gotten out a year and a half ago.
You'd gotten out here. Oh my God, it's at a new all-time high. Got out here, got out here, got out here. If you had picked tops. But you'd been wrong on all of them because the market came in mid. So picking tops and bottoms don't do it, folks.
But eventually, you do start to see the trend change. And that's what we're ultimately trying to observe here on Market Wrap is when we start to see the trend change, when we start to see it go below the dot plots, And then we see convergence signals such as high yield underperforming, relative to bonds. And we can potentially see, we didn't talk about the Japanese yen.
Yeah, what happened to the yen? You were going to go to Japan.
Yeah, I missed the opportunity. It's only down 4%, but you see other signals, and so
explain the Japanese yen, why it's so important. People are saying, yeah, it's up 3 or 4% now because of U.S. intervention. We went in and we bought the yen and sold the dollars against it, pushed the yen up a little.
Yeah.
Why is it important when the yen starts to fall apart?
Well, one of the key things that I'm watching really closely is one of these big macro trends is, and the big thing you always have to watch out for in markets is when there's a lot of debt. Debt ultimately leads to crisis. And so right now, where there's a huge amount of debt, it's government debt. Governments have been spending since COVID a tremendous amount of money, and they've continued, and they haven't really scaled back that spending since COVID. So U.S. is, debt deficits still 5-6%. France, Italy, even China has a debt situation with their property bust and everything else. So all of these countries have accumulated such a huge amount of debt.
But the largest amount of debt, government debt,
is in Japan. And so Japan is one of those canaries in the coal mine that I watch very closely. France being the other one in Europe. It was Italy, but they've kind of gotten a little bit more towards the center. But really France in Europe, Japan in Asia, those are the two countries that have the most amount of debt. And one of the ways that you can really monitor that sovereign debt crisis or difficulty is two ways. We monitor it every week here on the investment committee at Compaq. One is credit default swaps. So that's just how much the market is kind of pricing in maybe a default of these countries. So you can monitor that real time by watching the credit default swaps on the country's debt. The other one is the currency. And if the currency is really depreciating rapidly, that's usually not a good sign, right? Because we were buying everything. And so that's what's been, it hasn't been a rapid decline in Japan, but it's been eroding over a period of time as we've seen their interest rates go up and they have a huge amount of debt. And so the yen has weakened. And so basically the Treasury Secretary, Japan being one of our big allies, kind of came in and said, hey, we're going to offer you some support. And I think that's fine. But whenever a government has to get involved, it's usually not a great sign. Usually means things aren't headed in the right direction. But that's not the worrisome part. I think the worrisome part is then the reaction that the market has. And that's what we're going to watch really closely here, where I do think eventually, if France doesn't get their house in order, they're also going to see some potential, their credit default swaps are going to go elevated. And then the European Union, the central bank there, is going to have to come in and do something, just like they did with Greece. And so if you remember the Greek crisis back in 2011, the chairman at the time, he came in and said, we'll do whatever it takes, right? Mario Draghi. And immediately the crisis was over because the credit spreads came down because the market believed him.
Right.
The problem, or the one thing we have to watch is now when Scott Bessant said, we're going to buy $5 to $10 billion in yen, the yen came down. That's great. The market acted like it was supposed to.
The yen went up.
The yen appreciated, right, and the dollar depreciated, which is exactly what you would expect.
Right.
What we need to monitor here really closely is when the governments come out and say, hey, we're going to buy a bunch of yen. And the market goes, yeah, that's great, but the yen's going to still depreciate.
That's not good.
That's not good. And so then that's the market telling the governments that that's not enough. The crisis is bigger than what you think it is. And we need to push this, and you're not taking this seriously. We're going to continue to push it in this direction. And then that's when things become a slippery slope because the government starts to lose control of the narrative. And the question is when that next crisis comes, do these governments have the ability to continue to control the narrative? I do think within Japan, within China, within the US, the governments have the ability to control the narrative. Why? They control the printing press. They can actually kind of create the dollars, do these different types of things to try to mitigate through it. Europe and the European Union, because you have France, Germany, Italy, Spain, and all of these different countries united by the same currency, I think if they have a big deficit crisis, it could be a really, really big problem. And if there's a really big problem in Europe, that's a really big problem for the U.S.
and the world
as a whole. So, Japan is one thing. I think it's interesting, but I think it's just a little bit of a kind of introduction into sovereign debt, markets intervening, and then how does the markets react? And so
Something to watch. I don't think it's something. It's a slow burn. Basically, that's the why. Something,
but it's
something
it's
to
a
watch.
big impactful event when it does start to happen. And so, of course, if you're a weekly market wrap listener, you'll hear it here first when we start to get really concerned about that. But I think it is, everything's orderly now, everything's okay, but it's something we want to continue to watch here, and we will continue to do.
Small caps continue to push up. Not a new all-time high today, but still a nice move up. We might get a fourth wave pullback somewhere. We'll have to wait and see. International came down, made a pullback here, came to the 20-week moving average, bounced right off of it perfectly right here. Now it looks like it's going to head back up.
Yeah, and
That's the way it's looking.
it's still looking good. I think we talked about diversification, so continuing to look at diversification in your portfolio with some international, with some small cap, I think makes sense.
Oil came back up to nearly to the all-time highs last week. Now we're down here,
Yeah.
down to the 50-day moving average. We broke it this morning. We're above it now. Going into the close, it's 2014. This is 29.19. So came and tested the 50-day moving average. It's just all over the place. It's just what news comes out to what time.
Yeah, I think it's not even until it decisively breaks below now those kind of June, July lows, below 19 on DBO, or it breaks above 2350, which would be all new all-time highs. I think it's just a lot of chop, but the market's able to kind of, I think, weather it, in its current iteration, which is good.
Weekly chart on oil came down, came back up again. Today it's down. Well, it's down around here. 20-week moving average right around there.
It was down pretty big today. We look at DPO today, ultimately got down to 20.3. But once again, until we get below 19, it's still, we're in no man's land with the situation.
Treasury made a new high for the year.
Talking about divergence, so I was looking at some divergence. Looked like we saw some divergence here, where we made kind of all-time highs, or yearly highs in the 10-year Treasury, but it looked a little weak, reversed dramatically back down today. So I'm going to be watching this chart, as we always do, every day. But I think one of the things I really want to watch over the next week or two, as we headed towards the end of August, is if we see interest rates come down, and so bonds are going to rally, but we see high yield also continuing to trend down, that would not be good. And then you still got to wait, and then you have to kind of watch. I think that 200-day moving average is the key level to watch on the S&P. And then, of course, the 2,400 on the NASDAQ, 24,000 on the NASDAQ. Those are pretty tight stop losses right now in the market. Until you break those, I think it's just normal chop. But if you break those, and you're getting a lot of these other signals from the bond markets telling you, growth isn't looking good, I think now you might finally have the ingredients to potentially doing some risk management in your portfolio. So we'll continue to watch that.
Gold drifting, going nowhere, just back and forth.
It's kind of broke a long-term channel, that's been on the upside. So gold just seems to be in a tough spot. I think once again, as these governments, as central banks and governments also kind of in tough spots, they're having to liquidate some gold as well to defend their currencies. So I think that's also weighing on gold prices going forward.
Here's your favorite chart, the HYG versus AGG. They were sort of, this was down, this was up.
Yeah. So, but you look at the yellow line, it's been strictly, since October of last year. I did a 1-year chart this week. It's just been going basically straight up and trending up. So, nothing to be worried about. But once again, what we're always focused on is, the trend is our friend while it's moving in the right direction. When we start to see a trend change, and this is a very, very important one, that's when we just need to, sit up a little bit and pay attention. So something to continue to monitor here. But once again, all-time highs. Let's keep it all in perspective. Things are looking good.
Folks, again, don't forget, click on the subscribe button so whenever we post an update, you'll get notified. If you need help to figure out where you are, what's going on with your portfolio, do you have the right amount of risk or too much risk, not enough risk, give us a call at 800-388-9700 or just send us an email. Javaid or someone from the office will be in touch with you. Send an email to invest@compact.com. Those are thoughts, those are observations for this week. We will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.